Good afternoon and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. My name is Amanda Sylvia, and I'm the Senior Client Service Associate for SEM, and I'm happy to be assisting Chris today. I do want to start off with a few housekeeping items. Please use the Q&A button at the bottom of your Zoom window to submit any questions you may have throughout the course of the webinar. I will ask Chris to answer as many as he can at the end of the webinar. If you do happen to run low on time and do not get a question, Chris or myself will reach out to you directly at the end of the webinar to make sure we get your question answered. I'm really excited to introduce our speaker. Chris is Stonehearth's Chief Investment Officer. He brings over 20 years of investment management experience to our firm, working with both institutional and individual investors. He's responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. And I would like to thank everyone for joining us today in what's supposed to be winter, but I look out my window, it's looking more like spring than any winter here. We live in New England, so we have to expect the unexpected here with weather, so I'll take it for now. So again, thank you all for joining us for our first webinar of the new year. We're going to go through a presentation today, kind of look at what's happened. So kind of look at the fourth quarter 2023, what's happened since we last met, kind of what happened in 2023 in terms of performance. Then we'll kind of look at the current investment environment. And that's where I get the title for this presentation, Balanced. It's definitely a more balanced outlook than we saw at the beginning of 2023, but definitely with a positive tilt for risk assets. You know, you see a growing economy, strong technical backdrop, but, balanced against, a little bit of evaluation extreme levels and some concentration concerns we have in the U.S. equity market. Then lastly, we'll kind of take a look at how the data and the weight of the evidence is impacting our portfolio position as we look out to 2024. So with that, we'll look at fourth quarter 2023. Santa was very good this year, right? He delivered almost every asset class rose in the fourth quarter. And when we look about asset classes, we can see on the graph here that anything in blue, think U.S. equity, so S&P 500, U.S. small cap, NASDAQ, that's all going to be in blue. Anything in green is international, think anything over in France, Germany, and China, some of the Latin American countries. Anything in purple is debt, right? Fixed income, U.S. treasuries, corporate bonds, emerging market debt. And anything else that doesn't fit into one of those three categories, we put in yellow and we call it alternatives. So that's how this is laid out. And you can see from first glance, like we said, very, very strong quarter for all assets, really based on expectations, really of a soft landing and expectations of a dovish Fed. And we'll get into why we think investors may get a little bit ahead of themselves on that, but still expect that the rate environment will be more positive going through 2024. We did see the S&P 500 continue higher in the quarter, like we saw throughout 2023, up almost 11.5%. But we did see a difference in the fourth quarter. We saw that assets that have trailed for the year really outpaced the S&P 500, which was really influenced a lot by that Mag 7, which we'll talk about in a few minutes. And you see that on the left-hand side, REITs almost up 18%, U.S. small up 15%. That's something we haven't seen. Long-term treasuries in purple up that 13% over the last quarter. So again, a little bit different feel than the rest of the 2023. The quarter we did see, again, first glance, U.S. over international. Right, we saw small over large in the U.S., so small cap stocks outperformed the large cap cousins. We saw duration over credit and fixed income. We measured that by long-term treasuries, which is just basically pricing interest rate risk. You see that was up almost 13%, handily beating credit, which you can see with corporate bonds up 10%, junk up about 7%. That's more the corporate piece of the fixed income market. The only negative is commodity space, which is in yellow and all the way up to the right. You can see the investors in that asset class really not agreeing with the soft landing economic growth. But on the bright side, again, balanced, it's helping, right? It's good for inflation, good for consumers. Anytime you pay less for heating your house, anytime you pay less for filling up your car, that's a good thing for consumers. So expanding our time frame, out using the same color scheme that we saw the fourth quarter, we see a very similar distribution, right? Other than that little outlier in the NASDAQ there and the S&P, it's very similar to that fourth quarter. Again, large over small instead of small over large, but in general, we saw that it was really, really tough to lose money in 2023. Up across the board. Again, saw US over international. You see that in the blue, S&P up 26%. What a strong year for that. Handily beating international stocks at 18%. But still, 18% return is nothing to sneeze at. Unlike Q4, we did see credit beating duration, and we saw that in floating rate, 11.5%. High yield, 11.5%, beating really those long-term treasuries, which is actually up 3%. And one thing to note here, which is something that's different over the past few years, is you see that ag right here. And the ag is a total bond market. It's a global bond market, US bond market, I should say, up 5.5%. That's nice because the past 3 years, it was been down, right? So 2021, that bond market was down. 2022, that bond market was down. Something we don't see that often. And it was nice to see a reversal in 2023 of that performance, which is good, which has provided a good outlook for 2024. So we see that commodities did manage to poke their head out, right? They're up 1.8, unlike the fourth quarter, but oil still dragging down, still down almost 5% in 2023, despite all the turmoil in the Middle East. Oil just still can't seem to find a big bid out there in the marketplace. So again, very similar to the fourth quarter numbers, with the exception of the S&P 500 and NASDAQ, which is really for proxy for that Mag 7. So when we talk about that Mag 7, we talk about the names you've known, right? It's Meta, which is formerly known as Facebook, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, those top 7 stocks in the S&P 500. And you can see just how much they outperformed everything else in 2023. And you can see that top line right there, the 76%. That's the performance of just those 7 stocks. That translates, as they make up a big piece of the S&P 500, down to 26% for a total index. That leaves the remaining 493 companies only, and I say only with quotation because 14% is still good, a 14% return in the year. So this is when we talk about when we see that Mag 7 really driving performance, and that is just a very highly concentrated market in 2023. So that's kind of really what happened in 2023. And we're going to take a look at this concentration risk a little bit further down the presentation and what this means going forward for 2024. So for that, let's take a look at the current market environment, and look at what is and, really what will drive the price action of the market in 2024. Begin as we have recently with all these presentations, still, the biggest gorilla in the room is the Fed, right? They're having such an outsized impact. They won't always financial markets, but at least for now, given the current environment, they will. And what we're looking at here is the Fed funds rate. So this solid line here is kind of what's happened to the Fed funds rate throughout history since 1993. And we can see that, since we last met, the Fed did not hike rates. That's good. We did see a perceived Fed dovish pivot. So those are those 2 lines going down here. But that's what I really want to focus on in this chart. This really interesting part is those dotted lines. So what are they representing? Well, the purple one is the FOMC, which is just the Federal Open Market Committee. So just think the Fed and what they think from their meetings, what's going to happen to rates. So they don't see any more rate rises and they see a decrease, maybe 3 cuts in 2023. That green line, that's what the market thinks is going to happen, right? This is what they're saying that is going to happen in the marketplace, that the Fed's going to cut more. What they're saying basically is they don't believe the Fed. That gap has widened, right, since we last met. Investors were pricing in 6 cuts beginning in March, while the Fed, based on the purple lines, only has 3 and not until the summer. So this change in expectation by investors really helped fuel that rally in 2023. We do believe the chart, right? We do believe we've seen the peak in rates for this cycle, but we do think investors got a little ahead of the Fed's reaction function, as you can see on this chart with those dotted lines, which Chairman Powell is now trying to walk back as you see him out there giving all these interviews. And when we look at the real-time data, what is the market saying right now about the Fed funds rate? You can see that it's actually making some progress, right? It still has some work to do, but what we're looking at here is a probability of rates based on the marketplace. I am sorry because the chart didn't go over. There we go for that. So what we're looking at is the Fed Watch tool. So this is basically market expectations on what the Fed's going to do. These are the meetings coming up. We're only going to focus on this next one, March, because this really describes what happened in 2023 and the performance. And we look where we are right now. We're at 525 to 550 because the Fed, for whatever reason, can't seem to agree on one number. So now they wanted to announce a range. So that's what they've been doing, announce a range of the Fed funds. And you can see where we thought the Fed's going to be in March on January 5th, right? 31% said there'd be no change on the March meeting. Fully 64% said there's actually going to be a cut in March coming up. And these people over here were crazy. I don't know the 50 basis points where they came from, but over here, fully 64% of the people thought there'd be a cut in March. And we saw that gap with those dotted lines and really driving that performance. And we can see what's happened now, looking at the current data, that 64 has dropped all the way to 23. Still a little too high. Again, we're coming up very closely to this March, and we look at the data in the next few charts, we're going to see why we don't think a rate cut's there. And we believe the Fed, right? We believe in not fighting the Fed. And the Fed said, pretty much telegraphed there's going to be no rate cuts. So again, you can just see this change in investor sentiment over this time period really driving that performance. And the big reason we don't see any rate cuts is the data, right? And we know the Fed has a dual mandate, inflation and jobs. So let's take a look at it. And we'll take a look at inflation first. We're looking at different ways of looking at inflation. Definitely looking at the chart right away, you can see definitely improving, right? But not as much as you would like for the Fed to achieve its goal. The first graph on top is consumer price index, right? That's what people pay, growth in prices year over year. You can see it was up at 9% July 22 at its peak and is down, right? So definitely good progress. But at 3.3, still a little too hot for the Fed with their stated goal is 2%. The next one down is core. So that takes out food and energy. And again, I've talked to you multiple times about why they do this and why they shouldn't do this. My job is not to change the Fed's mind, it's just to react to what they do. And they like to use this core. And that looks even worse. That's almost at 4%. So that's almost double where the Fed needs it to be. The next one we look at is producer price index. Again, just looking at multiple ways to look at prices in the economy. Producer price index is the beginning of the chain, what companies are paying for those raw materials. And you can see again, low, much improvement, but really looks, at least on the chart for now, to have bottomed in July 23. So if this doesn't keep going down, it's kind of tough to see how we can get this much lower with the data coming in. And again, so inflation's just looking pretty better than it did back in 2022, but not enough for the Fed to really start lowering rates. And we look at the end is expected change in inflation rates. This is what the market thinks. And you can see it's really come down, right? So they really think inflation is going to come down. And that shows up in the gap of the Fed cut and really going to drive performance in 2024. The other piece of the dual mandate is jobs, right? And we see jobs are not helping inflation and it's providing support for a higher for longer interest rate environment. So that brown line there is the unemployment rate. You can see the last tick in November 2023, the latest we have data for is 3.7%. So an almost record low unemployment rate. So what economists call full employment. There's always going to be some people unemployed due to frictions and job changes. So again, you get it down to 3.7, you're at full employment. And even more important to us, we think, is that blue line. That's that wage growth. You see historically it's averaged 3.9% in the call out box over the past 50 years. And right now it's at 4.3. So above average wage growth, number one. It's also above inflation. So consumers have more money. And then when we look at more money coming to the pocket, what does that mean for consumers? More spending, right? We know consumers love to spend. It's 70% of the economy. So more money in their pocket, more spending equals more demand, economists tell us, equal higher prices, i.e. inflation, all else being equal. So again, not only is it keeping the Fed higher for longer, it's also impacting the other piece of their mandate and potentially pushing inflation higher with the strength in the labor market. And it's not only strength in the labor market looking backwards, which some of those numbers do, it's also looking forward. And I love looking at this chart to give the health of the job market. On the left-hand side, you can see the JOLTS, job openings, how many jobs are open out there in the marketplace. And again, definitely getting weaker, definitely kind of what the Fed wants to do, kind of cool off that labor market. But compared to history, when we're averaging about 4,000 open jobs in the marketplace, we have 8,700, almost double. So yes, getting better, but nowhere near slowing growth or contraction, still very strong job market. Look at the quits, upper right-hand side. Again, another way to look at the market. Into a softening labor market, or where you don't think you can find a job, people don't quit. If they're not getting other jobs, they don't quit. And you can see how elevated this is. Again, like all the charts we're looking at, balance, improving from the Fed's point of view, but nowhere near where it has been historically. So again, still very strong on that. And layoffs, you're hearing a lot more noise about this from the tech sector, gets a lot of press, but we want to kind of see through the noise, find the signal. And the signal in the layoffs is that while they're picking up, no doubt about it, you can see that little chart on the right here, going up and to the right, nowhere near where it's been historically. So again, still very strong. So again, as long as we're at or near full employment, decent wage growth, really tough for us to see how inflation drops meaningfully, putting a cap really on how aggressive the Fed can be with rates. So again, setting up for that investor disappointment. Another supporting data point for the Fed is monetary conditions. What we're looking at here is the cost of money, how tight or constricted the Fed's being. There's other measures out there. We use a lot of good information from Ned Davis. Strategist has some good information for us. Multi-factor models, 14 things, look at the M2. Other measures are good, but we like the KISS principle here. And for those who are unaware, the KISS principle is keep it simple, stupid. And we're just looking at the cost of money. So looking at the blue line, which is the 10-year treasury yield, just what that yields, you can see it's at 3.88. And we take out the inflation rate. And what we're using the inflation rate right here is from JP Morgan at 3.99. You take the difference and you get this brown line, and that's at 0.11. And to us, that's the cost of money, right? How easy is it to borrow money? How expensive is it to borrow money? And we can see throughout history, data going back to 58 is usually positive, right? It makes sense. There should be a cost to borrowing money. You shouldn't be, free money out there, lose money all the time. You can see during periods of stress in the marketplace, we have seen it before, but it bounces back. And we can see that over here too, with the COVID crisis that really went down to, almost record lows and bounced back. But you can see that compared to history, it's not tight at all, right? The cost of money compared to history is still cheap, implying loose monetary conditions. Loose monetary conditions fuel inflation and economic growth. Now, not a bad thing, unless you're Chairman Powell and you're trying to lower prices paid by cutting off demand with higher rates. We're nowhere near being a restrictive policy yet on that. So again, given those three things, we really see rates being higher for longer here. Also, we look at the economic activity and potential for the economy to grow. It's also looking up in the fourth quarter. So we're looking at here is the PMI surveys. These are business surveys going out to different companies, asking are things getting better, staying the same, getting worse. We break it up into two different parts of the economy. The red line, services. The green line is manufacturing. And you can see we talked about the services red line, been in expansion for a while. The consumer is really holding up the economy. But the big change you saw in the fourth quarter, you can see this green line here is this really starting to turn a little bit, right? And there's no guarantee this keeps going, right? It could change. We could get a growth scare. It could head down. But at least for now, it's heading in the right direction. And you have to turn up from a contraction before you get to expansion. And you can kind of seeing that for now. And especially when you look at the balanced nature of this, you get services and expansion, manufacturing and contraction, but getting better on a balanced view. It's implying more growth ahead, higher prices. We know that story, right? So again, really tough to find your way to a rate cut. And kind of thinking about the economy, rightly or wrongly, and we can go into that at a later time, we measure economic growth by GDP or consumption, right? How much we're spending and producing. And we're looking at the data here, shows above trend growth and expanding economy. So looking back to 2001, we got this 2% trend growth, or what it should be at a normalized growth rate. See, we were above that for a while. You see, great financial crisis kind of hurt that, kind of getting picked up right back here until COVID, and then we slammed down, and now we're heading back. So again, we're getting back to trend growth rate, implying increasing growth. And then we look at the numbers, were just outstanding. Third quarter 2023, quarter over quarter, seasonally adjusted and all that stuff, grew 5%, right? Year over year grew 3%. So above trend growth, catching up. Kind of hard to see, where we need demand decreasing in this type of environment when we're seeing economic growth. And then when we look at what's going to drive this going forward, you can see when we look at the makeup of GDP, that investment, housing, government spending, get all that, but fully 70% is consumption or the consumer. So let's check on the consumer's health, because they're going to have a big say in how this economy plays out in 2024. And on balance, you can see right here, they're doing very well, right? On the top line, we see the 30-year mortgage rate. You can see the last tick at 6.6, and I know that scares a lot of people because everybody's kind of used to the 3%. Again, that's recency bias. It happens. We look throughout history, and I like this chart to show that, it's usually higher than this, right? 3.3 was the anomaly, not 6.6. You can see it's still a little bit elevated, but coming down off the high, so getting better, helping consumers feel a little bit better about maybe purchasing a house. And also, we think about human nature, they're very adaptable and they get used to it. So right now, that recency bias is focusing on this. You can see we're a few months out, maybe the recency bias moves over to 6.6. And they're willing to get a mortgage at 6.4 or 6.3. So again, help the consumer feel a little bit better. Prices in the homes, helping consumers tremendously. We don't see a big decrease in house prices yet, right? Going upwards to the right. Look at the Schiller Cape Home Price Index. We don't see any big rollovers in housing pricing, helping consumers feel good. Another thing, retail gas. We saw the energy complex coming down, and we're starting to see it in prices. Again, higher than average, but economies grow over time. But again, still really much better than this 4.5 we saw per gallon. So that helps clients feel better, helps consumers feel better, willing to spend. And you can see that in the numbers. And this one I really want to focus on is index consumer sentiment. So this is how clients feel. And you can see they really weren't feeling good since COVID, right? It was really been down in the dumps, kind of flatlined. What we're seeing now is, a little bit of growth. So if we're getting good economic growth in this type of environment, what would you expect if you see consumers starting to pick up and getting really happy about their futures ahead? You may see some good economic growth. That being said, even if consumers want to spend, can they spend, right? And that's, do they have the capacity? And that's what we use in this bottom chart, right? This is debt service as percent of disposable income. So how much of your income, that's disposable, that's after taxes and everything, is going to pay down your debt, or at least just pay off your debt. We shouldn't say pay down. We don't like to pay down our debt in the US for some reason. Paying your debt, right? And you can see right now it's 9.78, looks elevated, but look throughout history, it's been an averaging of 11% of disposable income. And you look through those kind of gray bars, which are recessions, it really takes above that to really dent consumer spending and start getting to recessionary numbers. So again, think of what you will of debt, at least looking at the numbers compared to history, consumers still have some excess capacity to spend, which is good for economic growth since they make up 70% of the GDP number, which you saw in the previous chart. So again, overall, good for the consumer. And they're faring very well. Someone who is not faring well is the federal government's income statement. It is the stuff of nightmares. So anybody faint of heart conditions, please look away for the next 3 slides, and I'll let you know when it's safe to look back. So what we're doing is we're looking at the federal finances and the current borrowing needs. So we're looking over here is a total spending, 6.1 trillion for 2023, and their total financing. And you can see the gap is, get this, 1.7 trillion with a T. So they need to borrow just to cover actual spending 1.7 trillion. And you can see that the way to do that is you need to borrow, right? We've all have balance sheets, we all have houses. We know, if we spend more than we take in, we need to borrow. And you can see the federal government borrowing. And you can see that reflected in the net debt, right, as a percent of GDP. You can see, down here, and you can see just what's happened, just exploded in the OOs here, up at almost 97.6%, getting very close to that 100% GDP, and really, no end in sight. As you can see, the CBO forecast, which is non-political government agency, saying 2033 is up to at 120%. And again, it's going to have an impact at some time, and we look at this and we're like, how does this compare to history, right? Maybe government always just continues to borrow and always has this high level of debt. It's not. I mean, we're looking at the largest peacetime non-recessionary deficit in history at 7.5% of GDP. This is a federal budget surplus deficit from our friends at Strategis. And you can see it was lower there during COVID, and when the government stepped in and gave a whole lot of money to the economy to support everybody during times of crises. But even with the rise up, it's still at 7.5%. We look back, we haven't seen this since the great financial crisis, and this wasn't even there. And throughout time, we've never been this big of a deficit in the economy. We were a little bit bigger in World War II, but again, that was at wartime. So again, along with this extra interest expense and this tremendous amount of debt, as it keeps growing, we got to pay more interest on it. We also expect to see interest payments increase, right, as a percent of GDP due to the higher interest rate environment. We know the Fed has raised rates. We expect them to be higher for longer. So that's going to increase the government's borrowing cost. And you can see through the historical data, we're getting very close to a tipping point in government fiscal policy where austerity may be the name of the game. And this accommodating nature we've been used to since 1997 is not going to happen. So we're looking here, this red line, right? This percent of interest payments of GDP. That makes sense. We looked at that before. But what we're adding here is tax bills. And when we see these bars going up and to the right, it's a tax cut. I'm sorry, it's tax increase. When bars are going down, it's a tax cut bill. And you can see when interest payments are low, and they're over here on the right-hand side, you get more accommodative fiscal policy, right? Makes sense. Interest payments are a low piece of the budget. You can throw more money, cut taxes, or give your constituents more money. You can see that was the case through the 60s. And in the 80s, you saw a big sea change, right? As we have to pay for all these tax cuts and interest payments rose, the government had to change course and say, okay, we can't keep this going forever. We need to change. So we either need to raise taxes, cut spending. And we look at those lines over here, you can see that they actually, most of the budget deals in the 80s and the beginning of the 90s were raising revenues, right? So again, to bring this number down, and it worked. Then you can see 1997, this just fall off a cliff, right? You can see interest payments. This was due to those low interest rates, right? The Fed keeping it at zero, not to anything the government did. But the government took advantage of it, right? And they said, if the interest rates are low at 0%, and we have to pay a very low interest rate as a percent of our GDP, let's keep giving money away, either through tax cuts or through stimulus. And you can see those blue bars here. But again, like we saw back in the 80s, you have to pay the piper at some point, and you can see this going higher. So what does this mean? Why we're looking at this? Well, it means we have some tough decisions ahead. And this accommodative fiscal policy that has helped fuel some of the asset rises we've seen, the OOs and stuff like that, may be coming to an end. And the government may be more restrictive and have more government austerity in the marketplace. So again, just given the very nature of the interest payments, we may see less government support of markets going forward in 2024 and beyond. So for those of you who turned away, you can open your eyes again. We're going back to some good news. We'll kind of look at the US equity market. And what we're looking here is valuations. So again, you can see upward to the right in the fourth quarter, getting back to those extreme levels. One standard deviation we consider extreme level at 19.83. It's currently at 19.41, really driven by prices in the fourth quarter. So that's a good thing. The market went up. And we'll see with the call out here that we look through history, it is expensive, right? So we've talked about valuations before, and we're not seeing a lot of relief on that side. 30-year average is 16.59. You can look at the CAPE, which is another way to look at PE over a longer time period. They're at 32. Historical is 27. Price to book, price to cash flow. You can see it here. It's very expensive on any metric you want to use. This elevated PE, a lot is being driven by that concentration risk we talked about. We talked about that Mag 7 in the beginning. And right now we're looking at this chart is the top 10. So we take that Mag 7, and then we add in Berkshire Hathaway, which is Warren Buffett's company. We add in Broadcom, which is a semiconductor, and JP Morgan, which is a bank we all know, and we get this top 10. And we can see that PE number that we saw, 62%, top 10 is 26.9. Right. So again, that PE ratio really being driven by this, because it gives you 19.5. Those remaining stocks are at 17.1. Now, again, still a little bit higher than history, but definitely a lot closer and nowhere near extreme levels of valuation. So there is pieces and pockets of support if you know where to look, especially in some other stocks here. And this may be why these are getting a little bit overextended here. And we can see they're really punching over their weight. Earnings contributions, so how much do they contribute to earnings? 23%. The weight of them, 32%. Again, this is what we mean by concentration risk in the marketplace. It's balanced, right? It's a good thing the market's going up and you have some valuation support in these other names, but those top names in the index may be getting a little bit long in the tooth there and maybe be a little bit worried about what they're going to do in 2024. But there are pockets of attractiveness within this based on valuations where tactical allocators can take advantage of the fear and greed of investors. It's the old saying by Warren Buffett, be greedy when others are fearful and fearful when others are greedy. Well, that you turn to valuation, right? What are those names that got really sold too much or bought too much and went to too far extremes? And that's what we're kind of really identifying here with valuations. And the extremes are, if it's red, it's on a negative extreme. If it's green, it's a positive extreme. And you can see with what we've seen, nothing's going to shock anybody. Russell 1000 growth, which is filled with those Mag 7 names, appearing very high valuations compared to history and compared to itself. S&P 500, still the same story. But if you're willing to look a little bit further, look at the S&P 400, which is small cap, which is mid cap, 600, which is small cap, you start to see some pockets of attractiveness, right? You're not at those extreme levels, and some of them are even undervalued there. Looking further afield, you can kind of go over to across the pond into Europe and EM, you can see even more attractiveness. ETH was a little expensive here, but look at lots of green spattered in there. And you look at the individual countries, you can see what's being attractive from a valuation standpoint and where you can take advantage and tilt in and take advantage of some of that investor fear and greed. But valuation is just one piece. It's a big piece. Don't get me wrong. It's a very big piece. We think it drives long-term returns. But you also can't ignore the signals from price action. And when we talk about price action of assets, we're always talking about momentum. And what we're looking at here is that on that flip side of valuation, not just looking at what's cheap or expensive, but what has worked or hasn't worked in the prior few months, in the prior year. Again, same type of color scheme. Anything that hasn't worked in the past year or so is in the bottom three. Anything that has worked is in the top three based on itself and compared to others. And you can see what's being attractive on momentum. And you can see, as you would expect, right? We saw small cap underperform, so it's negative. We saw large cap outperform, especially the Mag 7. They're positive. Look at the EM here. You can see some green exposure in Brazil and India. China hasn't worked in a price momentum. So again, the holy grail, that fat pitch, is to get positive momentum and positive valuation. Investors live for those days. They're very few and far between. They do show up sometimes, but it's tough to find. So what you're really looking for as an investor is that balance, right? What's the best balance between momentum and valuation? We can get good exposure to both of those without taking too much risk, right? How much risk do I need to get good exposure to both of them? And you can see where we're finding opportunities there. In the marketplace, you look over internationally, we like to tilt into that a little bit. EM looks attractive. Unfortunately, China has its own unique issues in terms of their growth, the demographics, going through a property bust over there. They got some of their own issues, and I think that's really hurting EM. But overall, you can kind of tilt into some international assets, some small cap, while still maintaining exposure to large cap, really based on the strong technical picture you see up there. So closing out our equity looks, we're going to look at the technical market, and we're looking at the S&P 500 from a technical standpoint. And again, I think I've mentioned this before on these calls. I love this chart. It's my go-to chart. Looking at anything, first thing I kind of look at when I look at a stock, an index, anything. This is going back in time. And like we saw before, we always talked about the stuck in the middle presentation we did last quarter, where we're stuck in the middle of this trading range. And it would be positive to break out, and it'd be negative if it broke down. Well, very clearly it broke out, right? So that's a positive. Now, wouldn't shock us, especially a cyclical bull in a secular bull market sometimes comes back once it breaks through that resistance. So you may see it come back to 4,600, but that still remains in that upward trend. And we can see that from the moving averages. The blue line is the 50-day moving average. The red line is 200-day, up and to the right. That's all good. Look at the bottom chart, the MACD. It's short-term momentum compared to long-term momentum. We like when the black line's above the red line. We see that. The only thing that's kind of dinging it a little bit is that top one, right? That RSI, that sentiment, that's a little bit overbought. Maybe get too far ahead of itself up there at 70. Doesn't mean we're due for a pullback. Just mean, maybe we're just not going to rise as fast for a little bit, work off some of this excess sentiment and kind of move on to new levels. So again, pretty strong technical picture here. This really helped us kind of in our risk modeling, which we'll get to in a few more charts. So we do need to look at fixed income. And we're going to look at the yield curve. I know a lot of people find fixed income boring, but again, it's a big piece of the market, actually bigger than the equity market, and does with the Fed and cutting rates, or maybe not cutting rates as much, it's going to have a huge impact on the S&P 500. So look at the yield curve. So the current yield curve is in the blue line as of 12/31/2023. It's just what the government pays for different tenures of treasuries, right? So the 1-month treasury pays 5.4, 6-month treasury pays 5.3, a 2-year treasury pays 4.3. Usually this is upward sloping to the right. We haven't seen that in years. It's always sloping downwards to the right, which you call an inverted yield curve. And we actually saw it get more inverted in the quarter, driven by those sharp declines to the long end. You can see that from where we were last quarter, right, 930, we're at 4.7 in the long end. We're now at 4. Short end didn't budge. So you can see how that affects the shape. And that really is, that long end move based on easing inflation concerns and investor expectations of a rate cut, which we looked at and they may not get. So as we saw in the previous data, not sure they're going to get what they want. And when they want it, but at least for now, we're showing inversion in the yield curve and expecting lower rates ahead at some point. So the next thing we want to look at is the fixed income market. And so even with this adjustment, so we think, investors got a little bit too far ahead of themselves on rate cuts, and they may have to come up a little bit. And kind of seeing some of that in 2024 with the bond market. So, why is the bond market still attractive if yields may have to go up a little bit? The answer is yes, right? Even with the adjustment needed to account for the higher for longer rate environment, fixed income still has a vital role to play in diversified portfolios, right? As you're now being compensated for that interest rate risk through higher starting yields. A lot of this has to do with recency bias too. We talked to a lot of clients and say, yeah, fixed income hasn't worked. And we know it hasn't worked 2 years ago, but it worked last year, right? It was actually up. And then we look out forward that, yes, there's still interest rate risk. There's still the risk that rates have to come up, not by the Fed, but by investors coming up to where we think the Fed is going to go. But the big difference from before is the amount of income these products throw off. So what the recency bias says in the past 10-year median, that you could get about 1.7% in US Treasury. Now with inflation up at 9%, or even down at 6%, that's not a great trade-off, right? And you can see that across the fixed income complex. Corporates, 3.2, not a good trade-off. EM local debt, 5.7, closer to inflation, but still not a great risk-return trade-off. Then we kind of take a look at where we are now. There is a benefit for the Fed raising rates, and you can see this upward move in income. So US Treasuries on average now yield 4%. We look at corporates, they're at 5%. So if you have inflation at 3%, corporates at 5%, you're actually earning some real money now. And if you're willing to go up the credit spectrum, which we really like in this environment, emerging market debt, almost 8% income stream. High yield, 7.6. Now, this doesn't prevent bond prices from going down, right? When rates go up or investors' expectations of rates going up kind of rise. We know that when yields go up, bond prices go down. But what the difference is, you have a bigger buffer now, right? So even if prices come down 1 or 2%, you have a 7.8% in example of EM debt to buffer that, and you still have a good 6% return. So again, they really do provide a valuable addition to client portfolios in this environment. So before moving on to our risk modeling, I really wanted to check in with the corporate lending market on the health of the economy. As they tend to get there first, as they have more skin in the game, right? More on their balance sheet. And what we're looking at here is spreads over treasuries, right? For different parts of the fixed income market. So this top chart, investment grade corporate. So that's Apple getting a bond out there, right? I want to borrow some money. They lend in the investment grade corporate market. US high yield, more like Snapchat borrowing money. You expect a higher yield there. Mortgage-backed securities, those packages of mortgages rolled up and sold to the marketplace. And US agencies, you can think car loans and credit card debts. So what this chart tells us is how much over the government, right, because the government's the risk-free rate, am I required these companies to pay? How much do I think there's risk of them not paying me back? The higher this spread, the more risk I see in the marketplace, the more I think I may not get paid back by some of them. So you can use this as a proxy for what the banks who are on the ground lending money think about the economy the next 12 months, 24 months, even 48 months out there. When those spreads are compressed or lower, they see good times ahead. Don't think there's going to be many defaults. When those spreads widen, like we saw during COVID, you can see that they're scared. They may not get paid their money back, and they're going to require the companies to pay a lot more money. So when we look at this, what does it tell us about moving forward? Again, like the title of this presentation, balanced. On one hand, you can see by the tightness of the spread and the low rates compared to history that they don't see a lot of danger out there in the marketplace. They think they're going to get the money back. That's a good thing. Balanced. The negative side is complacency, right? Are they missing something? Are they just so complacent based on what's happened over time that they're missing something out there? That's why even with these record low rates, it still remains balanced. But still, until we see something really majorly break in the bond market and these rates stay low, it's easy for corporations to borrow money at cheap rates. It should be good for the economy moving out. So let's move to our risk models. As those long-term clients and listeners know that we use two different risk models. So look at the first one is this NDR, Ned Davis Research Fab 5 risk model. I'm only showing data going back here to 2019 because of space, because it gets really crazy if you go back in history, because they go back to 1981. He has over 40 years of live data. He uses multiple indicators, over 30 different indicators made up of 4 different pieces of the market. Tape, that's momentum. We looked at some of those charts. Sentiment, what they feel. Monetary, the monetary conditions, we looked at that too. And combo, which is kind of looking at overseas and valuation, a little bit of valuation, not a lot, but more of us going overseas. And you can see compared to last quarter, right, everything reversed. I mean, we were looking last quarter, the tape was bearish, it's now bullish. Sentiment was bullish, now bearish. Monetary combo, same thing, bearish. So you can see the impact of the performance in Q4. You can see it in his model score going straight up to the right. Now, what he does is when he's on a sell signal, which he was, right? He wasn't looking at a positive risk environment. Once it goes above +2, which it did at the end of December, he's on a buy signal. So he moved to a buy in the late December. He saw the improving tape, right? The stronger technicals. Even if he saw some concerns about sentiment, it's more than being offset by the looser monetary conditions, which are good for the stock market and those overseas assets outperforming. So again, positive. And we saw this improvement as well, not as much as he did. And one thing we do about our internal risk model is that we designed this ourselves. We looked at Ned Davis. We like to look at multiple indicators. Didn't think he had enough there that he wanted to look at a little different pieces of the market. And so we put a little bit heavier weight on valuation because we do think it drives long-term returns. So again, we call this a completion model, complements Ned Davis, but we're seeing the same things. Last time we met on 9:30, we're -4, and we moved up to a -1. Really on the big jump in the technical, right? And so we're neutral last time, 0-0, now +4. Different right parts of the market started to perform. We saw the MACD short-term momentum turn positive. We saw some good performance from small cap, right? We want to see the broad market and breadth in the marketplace. We saw all that improving. So that kind of really caused that big jump up. Valuation got a little weaker. No surprise after the data we looked at, we're at the lowest negative reading in valuation. So then you kind of turn into the swing vote in macroeconomic, and you saw this increase in the quarter, right? Up by 1 to a +2. That change is really driven by increasing copper prices. We use copper to kind of measure the health of the manufacturing sector. Are the increasing orders or decreasing orders? It's kind of when you look at the copper, it's the first thing in the production cycle. So you would think, and it has held throughout history, that when copper prices rise, there's more demand, which means there's more production going on, which means a stronger economy, and vice versa for the price fall. So again, putting that all together, you can kind of see how we got this big improvement. And the really difference between our model and the Davis model is just that valuation picture. But when you can put them all together, we're still in the same things. A stronger technical picture with improving macro is offsetting the weaker valuations that we see in the marketplace, providing a positive environment for risk. So with that, how does that affect our asset allocation? And what we're looking at here is asset allocation relative to Stonehearth Capital's moderate benchmark as of January 31st, and not as of December 31st, as of this last month, because as we saw a big improvement in the risk modeling. We took advantage of that by adding to risk in January, and I want to reflect that in this presentation. So again, this is as of January 31st. No guarantees in anybody's portfolio. It's a model portfolio. But we can see that really driven by we're now overweight equity, right? We moved to overweight from neutral. And really that was driven by the U.S. We're underweight U.S. last time we spoke. We saw that price momentum, some pockets of valuation really increased, and that just the technical picture improved where it was safer and more beneficial to take on equity risk. And we moved the U.S. up to neutral in that. Still maintaining a bias towards international developed, especially over EM, which is neutral, but international developed is overweight. We saw it in the valuation screen we looked at, right? Also, we have some China concerns in the EM. We talked about that. Demographics, they have a property issue going on, can't get out of their own way right now in terms of economic growth, COVID lockdowns. So all that being equal, we kind of want to stay neutral on EM. Fixed income, again, that balanced approach, right? Understand that there's a fear of rates rising here. Understand that the short-term memory is that fixed income goes down, kind of balancing that against rates are a lot higher now, and the economic environment is pretty good. Lack of defaults, so you should be able to kind of sit and clip, which means you kind of keep just sit there, take the bond and clip that income, which would offset any interest rate risk. And finally, funding that kind of equity increase to overweight was cash, funding cash. Cash yields right around 5%, that's still not unattractive, right? 5% is still good. We have seen some people out there, they have bank accounts, they have other accounts, and you're earning 45, 50 basis points out there. Drives me crazy to see that with big balances out there. We have many ways to get exposure to cash with FDIC protection, all the protection baked into the government that your bank has, a CD has, with more liquidity and getting you 4.5%, 5%. So please, if anybody out there has a big cash balance and is down there only earning like under 1%, please give us a call because there are better options out there. But even with that, we're underweight. But again, very, very conservative investor, 5% is really nothing to sneeze at. So before we turn it over to questions, I kind of want to go through some key takeaways from this presentation today. First, we saw 2023, it was an unexpected market rally, right? I mean, it's tough to go back in time. If you remember going into 2023, there was a recession right around the corner. Everything was going to crash. The Fed was going to raise rates and crash the economy, and everything was going to go to hell. Well, didn't see that, right? We really saw a big rally in the market. So it was one of the most unexpected market rallies in history. Really driven by multiple expansion, right? It wasn't a lot of earnings growth in there. There was some, but really a lot paying multiple expansion. We saw that on the valuation chart, and that PE ratio kind of grew in the year. Exhibited by narrow leadership, right? We saw that, right? The Mag 7 or the top 10, whatever you want to call it, really drove most of the performance. We also looked at investors' expectations of the Fed, right? And they're really fighting the Fed. We have a mandate here. We don't fight the Fed, right? Looking through history, has not paid to fight the Fed, and investors really are based on not on the trajectory, but just how far and how low they're going to go. So there is still potential for disappointment if investors don't get what they want. And the data is really showing that they're not, right? It's a balanced economic data, right? Like strength of consumer continues to support economic growth. And if we see that manufacturing really kick in, which we're starting to see some growth, it's really tough to find your way to a rate cut in that. But even if you don't find a rate cut, right, yield still appears attractive compared to recent history, being compensated for interest rate risk. And cash at 5%, which is still above the inflation rate, is really nothing to sneeze at in this environment. Then we kind of look at the risk modeling. We look at the technical picture. We saw, improving breadth, even though it's not as good as it should be. There is still some concentration risk. We did see some improving breadth. Overseas assets started to have positive performance, pockets of momentum in EM markets. So again, breaking through that trading range, having the MACD on your side, having the right parts of the market outperform. So overall, really strong technical picture in the marketplace. We saw valuations still not supported for financial assets, still expensive. Valuations are good for long-term returns, not for market timing calls, not for getting in and out of the markets, but we do know that over time, the more you pay for something, the less return you should expect. So it is a concern, but there are pockets of attractiveness if you know where to look. Economic data, right, still is showing support for risk. We're seeing some good economic growth. We saw GDP growing. The consumer appears healthy, willing, and able to spend, feeling good about the economy moving forward. So again, we still should see a pickup in the economic growth there. So overall, right, the risk environment continues to improve, and which is why we kind of move assets away from cash into that equity. We're seeing that improvement. We do think the right tail risk remains limited. So what does that mean? Well, if you think about financial asset returns is distributed around a mean, right? There's a mean return. This asset returns over to the right, which are positive. Asset returns to the left, which are negative. We put that right, what we call like a fat tail, which means those 24% returns, 30% returns in a year. Those are those outlier returns that do happen. We did see that in 2023. We think that has been reduced, right? Given where the investors' expectations of what the Fed's going to do. doesn't mean you can't still have a decent 9-10% return in the marketplace. We want to be able to tilt portfolios into that direction. And finally, remain balanced, right? Tilt into those tactical opportunities and take advantage of that valuation dispersion we're seeing in different pieces of the marketplace. So with that, I want to turn it back to my colleague Amanda to see if there's any questions out there.
Hi, Chris. Thank you so much for all of that information. I just want to remind everybody to use the Q&A button at the bottom of the Zoom taskbar there to go ahead and enter in your questions while we have just a few minutes here to answer those. So we'll just go ahead and get started. We have a few. As you look out to 2024, what are you watching most closely?
Everything. Everything. Yeah. Only slightly kidding. My main role and like what I really do, and like my kids ask me, like, Dad, what do you do all day? I tell them I think, and they kind of laugh at me and say, you don't think? I'm like, I do, I really think. But what I do every day, is constantly look at the current opportunity set, right? Try to figure out what we should be doing for client portfolios based on the data and all the data that's out there, and and what we know today. We really let history, models guide us. So we stay away from kind of using one data point, right? Since you concentrate on one or maybe a few data points, you end up with tunnel vision, right? You get an incomplete picture of what's going on in the marketplace. While you're looking over here to the left-hand side, there'll be a whole bunch of things happening over here to the right-hand side that you miss because you're so focused on one data point. So again, that tends to lead to bad decisions. So we kind of use a weight of the evidence of multiple data points, which is why I say everything. And, it's not everything, but it's using historical data. Ned Davis has over 40 data points. We have over 12 and a whole bunch of other things that play an important role in providing what's going to happen in the marketplace. So that being said, I will give you one piece. I think the fixed income market is someplace to really look at, and especially when we talked about those spreads, right? We saw over the treasuries, those lending rates. They really should play an important role, right, in providing early clues to any economic troubles ahead. It sounds funny, but look to bonds for clues on the equity market in 2024. But still, make sure you take a balanced approach and look at everything.
Next question that we have here is we have a few questions in the queue about the Bitcoin ETFs. So to consolidate them, could you maybe give us your thoughts about the new product?
Sure. Yeah, it's getting a lot of attention lately, right? The Bitcoin ETFs. I'm sure most of you, by asking the questions, I'm sure you heard the SEC approved trading of spot Bitcoin ETFs, replacing the one ETF that was not a spot Bitcoin ETF. Now there's 6 out there. So thinking, well, first from a performance standpoint, right? I think it needs to take a breather. From what we've seen, it's a classic buy the rumor, sell the news strategy, right? In terms of everybody anticipating this, you saw it really run up, right? From the high 20s, and I think it's in the low 40s currently right now. I'm just using Bitcoin as a proxy. That's the ETF, that's the coin we're looking at. And then we kind of seen it come down a little bit to 42. So I do think it needs to take a breather, and no matter how you get access, I look for it in the 30s before adding exposure. Because remember, we had access to Bitcoin before, maybe not an exchange traded product, but you could go out and buy it on Coinbase, which is an exchange. It's not the ones you heard about, and you can do it on a hard drive too. In terms of the ETFs and what they mean, we always say we're wrapper agnostic here, and that's what an ETF is. It's just a wrapper. A way to own something. So you still own Bitcoin with a custodian, just like before, but now it's a financial firm that right? Fidelity. What's the other, losing my trip? BlackRock, right? The biggest one out there. They're just charging you a fee for easier access. You could always get access before, it's just a little bit tougher. So they're charging you a fee to hold this. It's just a wrapper. It looks like the usual big names going to win. Fidelity and BlackRock are 2 of the biggest. They have the biggest ones out there. They each collected about $1 billion. So they're collecting the most assets, and they're on the low end of fees, which makes sense, and the big household name. So we expect them to win this game in the end. More power to them. I think the larger impact, is how it behaves, not Bitcoin going forward. Going back before the ETFs, it used to beat to its own drum, right? It just kind of did its own thing, didn't trade with equities. We've seen this before in mortgages, right? And mortgages just kind of traded out there until they wrap them and put them on an exchange, and they become more correlated with traditional assets because the same people, the same hedge funds, same financial companies all hold them in their investment portfolio, and they trade them the same. right? So again, by rolling out these ETFs and people rushing in, you lose one of the main benefits, at least what I think of Bitcoin, is that the diversification piece, right? And that it does trade differently. And that increases contagion risk. That being said, we still think it's safe to own. Again, want to get it back down to the 30s before buying it. But in terms of portfolio construction and how we view it here at Stonehearth, we view it more as like a satellite holding, not a core holding of a diversified portfolio. Think about like a collectible investment, right? Like wine or art, as beauty's in the eye of the beholder with Bitcoin. So it's more of a kind of bolt-on approach to get that exposure for Bitcoin. So I hope that helps clear it up for everybody out there.
Thanks, Chris. Looks like we're running a little bit low on time, so I'm just
Okay.
gonna use this last question here. The federal deficit has always scared me, and I didn't think it could happen, but you scared me even more. Uh, how come we don't hear about the debt and deficit? And are you worried about the impact that it would have to your portfolios?
Yes, 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 and yes, but not yet. And you're right. I mean, whoever asked that question, it just doesn't scare me. I mean, it absolutely frightens me. Right? I have 3 kids. The mess we are leaving them hurts me to the core. I mean, I can't imagine what they're going to have to deal with. This stuff we left them. And it gets to your point, like, why don't we hear more about it? Why doesn't anybody talk about this? Why isn't it screaming from the fence post? You haven't heard a lot about it since Ross Perot, showing my age here a little bit, kind of had his charts up there, talking to Bill Clinton. But, I think the problem is it's just too big, right? And there's no easy solutions. No one, especially politicians, like to talk about the solutions that could potentially solve this, right? Cut spending. No one ever wants to say when cut spending and raise taxes. We know how that turns out in politics when you try to raise taxes. So, they're just too big of a problem. They don't want to face the solutions. So they just don't look at it, right? And they're not being pushed to do so yet either, right? It's out there. It's been out there for a while, but no one's pushing them to do it. By the market yet. That was the so-called bond vigilantes from the Bill Clinton days, right? That should push them to be more, have austerity. Better to just not think about it, right? And kick the can down the road. It's worked for the past 15 years, so it must work for the next 15. And that was a joke. I don't think it will, but again, that's what people are thinking, right? I do think it will. It will and has worked for a while. But yes, eventually we're going to run into the issues and it will hurt. The issue is that it's, tough to measure. Since being able to fund our deficit, it's really all about confidence, right? Issuing debt by the federal government, we can tax our own citizens. So as long as investors, both domestic and international, those bond vigilantes are confident that we're going to pay our debt and that we can tax our citizenship to pay our debt, they're not going to get too upset, right? I mean, there is a tipping point, right? And that famous book, This Time is Different by Carmen and Rogoff, back for the old financial crisis, kind of identified it, right? And it's right around that 100% where we're getting close, but it's still a confidence game. It's not a hard and fast, you hit this and you roll over. It really is a confidence. That loss of confidence in the marketplace is the tipping point. So we're watching closely, but at least for now, it's a next year, 5 years, 10 years down the pike problem, just not current one. So from an investing standpoint, building out client portfolios is something we watch, it's something we take into account, but it's not a negative yet. But closing out, from a personal standpoint, it is something we should all be worried about, and it needs to be handled at some point.
Chris, it looks like we've got 2 more minutes. So if you're good for another question, it says, we saw what happened in the mortgage market. With AI, should we be concerned with potential risk issues? There's so much we don't know.
AI in the mortgage market. So I think those kind of really 2 questions, right? The AI and the mortgage market. So AI, artificial intelligence, for those out there, those are chat GPTs and a whole bunch of other things going on behind the scenes. There is a risk, like any new technology, right? There's always a risk in how fast and how furious should you move forward by ignoring those risks. So I don't think that existential risks, I don't think there's an AI bot that's gonna come up and kill the entire society, but I think we do have to take a measured approach to the kind of AI situation. In terms of its impact on the mortgage market, I'm just trying to think through, maybe it's because AI is going to be your mortgage lender now and approve you or disapprove you. But again, I think it's going to impact multiple markets. You won't have the neighborhood bank anymore. You can go to a big online bank. So it does support the bigger players in terms of that. In terms of the mortgage market, right now, we don't see a lot of risk. A lot of people are down at 3%. So even as rates go up higher, they don't have a lot of variable rates, right? Because like most people, if you were lucky enough to be able to, if you saw rates down to 3, you put in a fixed mortgage loan. So it's not going to impact investors. We don't see a lot of risk in the mortgage market right now. Going forward, it's actually pretty attractive in terms of where it is from an investment standpoint. So I kind of know I went in circles there, but I was just trying to get an idea about your question. So yes, risk to AI. We do think it's muted. We do think we need to take care of it. It's going to affect markets left and right. In terms of investing in it, you know, we kind of like the picks and shovels, the old gold rush analogy, you know, investing in the picks and shovels, not the gold. So some of those companies that are building the machines that NVIDIA is going to do, and the data centers that AI needs to run on, is kind of where you want to be in that space.
Chris, thank you so much for all this information today. I do just want to remind everybody, we do host these CIO's Corners quarterly. So our next CIO's Corner will actually be on May 1st, 2024 at noon. So you can head right over to our website. It's www.stonehearthcapital.com. And if you just scroll down right on that main page, there's a link to sign up for that. So thank you all for joining us today, and we hope you enjoy what's left of winter, hopefully not much.
Thank you, everyone.